Alphabet, parent of Google, just announced the largest equity raise in its history, $80 billion, raised in a single day to build artificial intelligence infrastructure. And Berkshire Hathaway agreed the same day to pour $10 billion directly into the stock at $351 a share. 54 Wall Street analysts cover this stock. 49 have a buy rating, 0 have a sell. The narrative is everywhere. AI is the future. The smartest money just backed it. Get in now. But we aren't Wall Street. We ran Google through our 5-factor grading engine, our forensic cash flow model, and the math told a completely different story. The engine flagged a severe gap between the stock's current price and its intrinsic value. In a few minutes, I will reveal that exact number. But first, let's follow the money. Let's break down Google's first quarter 2026 income statement. Total revenue $110.1 billion in a single quarter, more than some countries make in an entire year. And inside that number, one story dominates: Google Cloud, up 63% year over year. That is the AI growth the bulls are pointing to, and it is real. After cost of revenues, gross profit lands at $68.6 billion, a 62% gross margin. Excellent by any standard. Operating expenses eat up another $28.9 billion. $17 billion of that is purely research and development, the cost of keeping the AI lights on. Operating income $39.7 billion. Operating margin 36%. A beautiful business on the surface. But here's what the headlines completely miss. There is a $37.7 billion block labeled Other Income, sitting right next to $39.7 billion of actual operating profit. Where did it come from? Unrealized gains on investments. Paper profits. The investment portfolio went up on paper. The company said it themselves in the earnings release. These gains may not repeat. Strip them out and real net income falls from $62.6 billion to about $33.9 billion. Wall Street analysts ran the headline, "We run the real number." GAAP earnings per share, $5.11. Adjusted EPS on the actual business, $2.62. The street expected $2.63. On real operations, Google missed. That is the first crack in the narrative. Now, free cash flow. Operating cash flow was $45.8 billion. Sounds powerful, but CapEx, the cost of building the AI empire, was $35.7 billion. For one quarter, free cash flow lands at $10.1 billion on $110 billion in revenue. That is a 9% free cash flow margin. And it will get worse. Full year 2026. CapEx guidance is $180 to $185 billion, nearly double what Google spent in all of 2025. The AI bet is all in, and right now it is burning cash. 5 factors, 5 scores. Every number calculated from real data, not guessed. Let's run the model. Factor 1, growth and forward outlook. Weight, 22%. Revenue growth year over year, 17.5%. 459% above the sector median of 3.1%. But it trails Google's own 5-year average of 17.7% by 1.3%. Score, 7 out of 10. EPS growth year over year, 46.4%. 588% above the sector median of 6.8%. Score, 9 out of 10. Forward analyst projections are also solid, but those are estimates, not recorded data. So, growth and forward outlook scores 8.3 out of 10. Factor 2, profitability and quality. Weight, 25%. EBITDA margins at 38.2%. Return on equity at 38.9%. Both genuinely world-class against the sector. But one metric breaks the entire block. Levered free cash flow margin, 6.6%. It falls below the sector median of 9.1%, and it has collapsed 62% from Google's own 5-year average of 17.4%. Score, 1.5 out of 10. That single metric pulls the block all the way down to 6.9 out of 10. Factor 3, cash flow strength. Weight, 18%. Capital expenditure as a percentage of revenue, 26%, versus a sector median of just 3.4%. That is 661% above peers and nearly double Google's own 5-year average of 13.1%. Score 2 out of 10. Levered free cash flow growth, negative 51.2% year over year. Score 2 out of 10. CapEx is destroying the cash flow. Cash flow strength scores 5 out of 10. Factor 4, balance sheet safety. Weight, 15%. Net debt to EBITDA, negative 0.19 times. That is net cash, not net debt. The model assigns that a perfect 10 out of 10. Total debt at just 13.6% of total assets. The balance sheet is clean. Balance sheet safety scores 8.5 out of 10. 3 of the 4 blocks score 6.9 or above. So, if the business is genuinely this strong, why does the raw composite sit at only 5.9? Factor 5, valuation and relative pricing. Weight, 20%. 2 metrics. Both score 1 out of 10. EV to EBITDA, 26.9 times. The sector median is 10.4 times. Google trades 159% above what the market pays for its peers. And against its own 5-year average of 18.3 times, it is 47% more expensive than its own history. Price to cash flow, 25.1 times. The sector median is 7.5 times, 234% above peers, and 34% above Google's own 5-year average of 18.8 times. Block score 1 out of 10. When you strip the valuation score out and look only at the underlying business, the quality score stands at 7.1 out of 10, and that is genuinely world-class. But when you put that score back in, the composite collapses to 5.9. And so the engine is delivering 2 verdicts at the same time. The business is exceptional, but the price is a complete disaster. Here is the fair value. The communication services sector typically trades at 7.8 times. Because Google scored 7.1 on business quality, the model adds a premium on top of that. 3 scenarios, based on how large that premium is. The bear case. A 1.1 times sector multiple. Fair value, $142. The base case, 1.3 times, giving Google a 30% premium over its sector peers. Fair value, $168.79. The bull case, 1.5 times the sector. The maximum premium our model will run for any stock. Fair value, $195. Even the most generous scenario, the absolute best case, still shows a 47% downside at $368. Bear, down 61%. Base, down 54%. Bull, down 47%. There is no scenario in this model where $368 makes sense. The verdict from the 5-factor engine is clear. Looking purely at the fundamental math, the stock is heavily overvalued at today's price. But here's the reality. I am an analyst, not your financial advisor. This channel doesn't exist to tell you what to do with your money. We build the forensic models, we present the raw data, and you make the final call based on your own strategy. If your portfolio prioritizes top-tier growth, forward outlook, and a pristine balance sheet, Google remains an undeniable powerhouse. The business quality is absolutely there. But if you are an investor who prioritizes cash flow strength and paying a fair valuation, the math is telling you there might be far better opportunities in the market right now. You have the data, the decision is yours. So, I want to know your strategy in the comments. Are you buying the growth narrative or are you stepping aside until the valuation makes sense? Tell me below. And hit subscribe. Because next week we run the 5-factor grading engine on NVIDIA. The results are going to shock you.